Capital income tax in general equilibrium computation with Chapter 5 Welfare Tau K. Hello and welcome to my tutorial on the effects of capital income taxes. In this tutorial we will study the general equilibrium effects of an abolishment of capital income taxes on labor, production, savings and welfare. And we will find tremendous effects. So this is really a significant policy change. Let's look at some results here first. If we abolish capital income taxes and finance the shortfall in taxes by higher labor income taxes, production will increase by 16%. Savings will even increase by 29%. And welfare will increase by almost 4% of total consumption. So this means that in the United States, each year, welfare would go up by $475 billion. Or if we convert it into per capita variables here, each US citizen could consume an extra $1,400 per year. Now this is really a strong effect, and I will tell you in the following how I computed it, and you can use my computer programs either in MATLAB or Gauss to recompute it and do your own sensitivity analysis. So let us look into the model description first. I would like you to download my slides on Chapter 5. Which is available from my homepage on my book on public economics. And you would also benefit to download the computer code either in MATLAB or Gauss, Chapter 5 Welfare Tau K. So let us go into the slides. And let me get to the first page. Public Economics and Macroeconomic Perspectives, Chapter 5, Income Taxes. We will study the section on capital income taxes, section 5.4 in the book. So let us look at the neoclassical growth model. Households maximize intertemporal utility, so this is just the sum of discounted utility, instantaneous utility in period t, and the discount factor is denoted by beta. Utility is Cobb-Douglas, so the weights on consumption and leisure amount to iota and 1 minus iota respectively. So we assume that each household has, or the representative household has an time endowment of 1 unit, 100%, and he works L% of his time, and the rest, 1 minus L, he spends on leisure. Sigma denotes the inverse of the intertemporal elasticity of substitution. The household faces the budget constraint 15. So on the left-hand side we have the expenditures on consumption and investment into capital stocks, or equally here savings. And on the right-hand side we have the income of the household. So expenditures consist of consumption CT and increase of the capital stock KT plus 1 minus KT. So the only asset of the household is physical capital. His income stems from labor, WT-LT, so WT denotes the wage rate, and labor income is taxed at rate tau-LT, and from interest income RT times KT. So we will distinguish two cases of capital income taxes. The first one is where depreciation can be deducted from your taxes, so you only have to tax your income RT minus delta times KT at the rate tau K. In the second case, you cannot deduct capital depreciation, so you have to tax total interest income RT KT at the rate tau K. Now let me mention to you that these two cases imply the identical allocations in our growth model, in our neoclassical growth model, if tax revenue are the same in the two cases. Now, the first order conditions from this optimization problem are presented by equation 16. So the first equation is the first order condition with respect to consumption, the second one with respect to labor, and the third one with respect to next period capital stock KT plus 1. According to 16a, the marginal utility of consumption is equal to the Lagrange multiplier lambda t, which we can identify as the marginal utility from extra income. According to the second equation, the left-hand side is the extra utility when we work an additional unit of time. So then we get net wage 1 minus tau L times W. And this converted into utility units, we have to multiply it by the marginal utility lambda. On the right-hand side, we have the marginal utility of leisure. So of course, in optimum, these two have to be equal. Otherwise, we could increase our utility by either increasing leisure or increasing work. Equation 16c is our Euler equation, our Keynes-Renzi rule. So on the left-hand side, we have the marginal utility from consuming an extra unit, and which amounts to lambda t. And if we save it and invest it in the capital market, we get the return 1 plus 1 minus tau k times r minus delta. And this gives us utility lambda t plus 1 in the next period, and of course, to make it comparable to this period, we have to discount it by the factor beta. And again, these two, the utility from consuming an extra unit today or saving it, must be equal. Otherwise, we could increase our lifetime utility by shifting our consumption either into the present or into the future. The production side of the model is pretty standard. So we have a production technology which is described by Cobb-Douglas technology. Yt is equal to kt to the power alpha times Lt to the power 1 minus alpha. So 1 minus alpha is the wage share in the US economy. And since we assume perfect competition in goods and factor markets, and wages and the real interest rates are given by the marginal product 18a and 18b respectively. And in the final sector of this economy, the government sector, we assume that total government expenditures GT are equal to tax revenues from labor income taxes and capital income taxes. Now, these steady-state equilibrium conditions are presented by equations 20. So equation 20a is our Euler equation. Equation 20b is our first order condition with respect to labor. 20c and d are the marginal products of labor and capital are equal to the wage rate and the interest rate. Equation 20a is our resource constraint, which we can derive from inserting the fiscal budget and the marginal products of labor and capital in the household budget constraint. And equation 20f is our resource constraint in steady state. Now, this will be solved with the help of a computational program. So we calibrate the parameters. So in particular, we find that the capital income tax rate in the United States over the last 50 years has averaged 41%. The labor income tax rate is equal to 23%, and we fix labor supply at 0.3 in the original steady state. So how do we compute the other variables? Well, we also have to calibrate a couple of other parameters. For example, beta is set equal to 0.96, which implies a real interest rate after depreciation of 4%. The depreciation rate delta is set equal to 10%. And alpha is set equal to 0.36, the capital income share, or 1 minus alpha equal to 64%, the labor income share. Now, with the help of these calibrations, we can compute the interest rate R in steady state with the help of the Euler equation 20a. This provides us, with the help of equation 20d, for a value of the capital intensity K over L. Now, with our condition that labor supply should be equal to 0.30 in steady state, we can compute K, the capital stock. With the help of K and alpha, we can compute the wage rate W from equation 20c. From equation 20f, we can compute government expenditures G from the right-hand side, or from the tax revenue, so we can compute tau LWL plus tau KR times K. And from the resource constraint, 20E, we then can compute consumption, C, which is equal to production minus government consumption G minus depreciation delta K, which is our investment in steady state. Then we use equation 20b, the first order condition with respect to labor, to calibrate the parameter iota in the utility function. So notice that we have tau L, W, C, and L. So the only unknown variable in equation 20b is iota, and we can compute iota with the help of this equation. So this is an easy recursive equilibrium system, and we will find iota is equal to 0.3355 in the first case and 0.356 in the second case. Government consumption amount to 21 or 30% depending on the deductibility of capital depreciation from capital income taxes. Now, this is computed with the help of chapter 5 welfare tau k, or the MATLAB program chapter 5 welfare tau k.m, which you can download from my homepage and which we will turn to after we have reviewed the results from our computational exercises. So what we do right now is we do a comparative steady state analysis. We reduce our capital income tax tau k and keep government consumption G constant. So as a consequence, we have to increase our labor income tax tau L so that our revenues are again equal to our expenditures as provided in equation 24. Now let me show you the results for this exercise. In the first case, that depreciation is tax deductible. Start with the lower right panel. Our initial value of the capital income tax rate tau k is equal to 41%, and we have a labor income tax rate equal to tau L. Now, as we reduce capital income taxes to 0 and beyond, our labor income tax increases. As a consequence of higher labor income taxes, we reduce our labor supply from 0.30 to 0.285. So here the substitution effect of lower net wages is stronger than the income effect. We also increase our savings. So notice that our after-tax return on capital increases. So we increase savings and our capital stock increases from something like 1 to 1.3. Now we have two effects on production. One production factor capital increases, the other production factor labor decreases, and the effect on savings is stronger than the effect on labor. So as a consequence, output increases by 16% from when we reduce our capital income tax rate from 41% to 0%. Consumption increases as well, even if we decrease capital income taxes beyond the threshold 0. And as a consequence, utility increases anonymously in steady state. So when labor falls, leisure increases and consumption increases. So both arguments of the utility function increases and therefore welfare increases. And if we compute the consumption equivalent change, so by how much we could increase consumption in old steady state at the capital income tax rate 41%, well, we find that consumption could increase by more than almost 4%, 3.4%. So here are our quantitative effects. If capital tax is abolished in the first case, and we set tau k equal to 0, we have to increase the labor income tax rate from 23 to 30%. The capital in stock increases by 29%. Labor falls by only 4%. Output rises by 16%. Consumption by 1.9%. And our welfare effect is 3.4% of total consumption. So this means each household could consume an extra $1,400 per year. This is the utility gain if we cut capital income taxes to 0 and finance a shortfall in taxes by higher labor income taxes. Now let us look at the effects when we cut capital income taxes tau k to 0 in the case that depreciation is not tax deductible, our case 2. As you can see, the qualitative responses of labor, capital, and production are the same. But now we have a turning point of consumption around 5%, at the capital income tax rate of 5%, then it decreases. So how can this happen if output keeps on rising even below capital income tax rates of 5%? Well, we have to spend a larger share of production on depreciation, so to replace depreciated capital stock, and therefore beyond 5% our consumption actually falls in this case. Now we have an optimum of welfare which accrues at the capital income tax rate tau k equal to 0. So we have increasing leisure over the whole range that we consider up to minus 10% of tau k, but consumption starts to fall at 5%, so the optimal capital income tax rate is equal to 0 in this case. And the welfare effects are even much stronger, 17.3% of total consumption, or more than $5,000 per capita per year in the United States. Now, you might wonder, is this just coincidence that the optimal capital income tax rate is 0? And Chamley and Judd have shown independently, no, this is no coincidence. In fact, the long-run capital income tax should be equal to 0. That's the famous Chamley-Judd result. Now, in order to show this, just proceed as we did. So let's assume that government expenditures are exogenously given, and they have to be financed by distortionate taxes tau L and tau K on labor income and capital income. Notice that we cannot use lump sum taxes, otherwise, of course, it would be optimal just to apply lump sum taxes and do not use distortionary income taxes. And we look at the case 2 where depreciation is not tax deductible. Now the Renzi problem looks at the following case. So let's first look at utility maximization. As we have just considered, the household maximizes intertemporal utility subject to the budget constraint. So the Lagrangian for this optimization problem is provided on slide 55. And the first order conditions are presented in equation 21. Notice that we have not used a specific utility function, but have just used a general utility function with standard assumptions on the utility functional form, so that we, for example, have a positive but decreasing marginal product of marginal utility from consumption. And then we can just derive the equation, first order condition, just as we did for the specific utility function. We can derive it for the more general function, utility function. So according to equation 20a, this is the first order condition with respect to labor. 21b is the one with respect to consumption, and 21c is the first order condition with respect to next period capital stock, our Euler equation. And we can eliminate the Lagrangian multiplier lambda t from this equation to obtain equation 22a and b. Now let's study the Renzi problem. The Renzi problem is the following second best optimum. The government is benevolent and just wants to maximize the intertemporal utility of the household. And the constraint of the government now is the resource constraint as given by equation 23. So total consumption private CT and public GT plus next period capital stock KT plus 1 is equal to production F of KT LT and capital stock minus depreciation 1 minus delta times KT. So we only assume that production F has constant returns, that the marginal products of capital and labor are of course decreasing, and that we have competitive goods and factor markets, so that the factor prices are equal to the marginal products. So WT is equal to the marginal product of labor, and RT is equal to the marginal product of capital. Now the Renzi problem now is to maximize household utility subject to the fiscal budget. So this is the constraint with the multiplier psi t, subject to the resource constraint. So this is the constraint with the multiplier theta, and subjected to the first two the two first order conditions of the household, equation 21, with the multipliers mu1 and mu2. So the Renzi policy is the one of a benevolent central planner who takes the behavior of their household as given, as presented by the first order conditions of the household, and has two constraints: his fiscal budget, so that he has to finance his government expenditure exogenously given government expenditures G, and the resource constraint. And the solution to this problem, the optimal labor and capital income tax rates over period T to infinity, that's the Renzi policy. So this is our second best policy. And what you can show, and this is provided in the appendix of chapter 5 in my book, is that the optimal tax rate tau k in fact is 0 in the long run, in the new steady state. So what we found computationally, you can also find this by pretty harmless assumption with respect on your utility function and your production function U and F from the Renzi policy. This has been shown by Chamley and Judd. Now let me give you a couple of comments on the Chamley-Judd result. First one, the optimal wealth tax is also 0. So that if you assume that you tax wealth at a rate tau v, for example, then you can show that this tax should also be 0 in the long run. So you can look at this proof in my solution manuals, and where I have solved the problem 5.3 of my book. So you can download this solution manual from my homepage as well. So let me skip into this solution manuals here and show you how it looks. So here's my solution manuals, and there's question problem 5.3. Show that the numerical results also holds for the Chamley-Judd result also holds for the wealth tax, and we assume that the wealth tax here is paid proportional to the capital stock, and in the solution manual I derive that the Chamley-Judd result also holds for the wealth tax. So let's get back into the slides. My second comment is that this result only holds in the steady state. So during the transition, this result need not hold that capital income tax rate should be 0. So for example, with Hans-Peter Grüner, I did an analysis that's published in the Oxford Economic Journals, and we consider the case that the capital income tax rates tau k can only be changed once and for all. So from the present 41%, you just cut it to, let's say, 5%, 10%, or 0%, and we study the effect on the transition, and also consider the welfare effect, so which is the tax rate that maximizes intertemporal utility if you just consider once and for all changes. And we find that in this case, the optimal tax rate is equal to 9%. So the United States, in our analysis, should cut capital income taxes today to 9% and keep it there forever. Well, there's also literature on the capital income tax rate, which considers not the per period fiscal budget, but considers the intertemporal government budget, which is provided by the equation 25. So in this case, the present value of tax receipts must be equal to the present value of government expenditures. So in this case, the government may run temporary deficits and accumulate debt, or even run surpluses and accumulate savings, and from which it pays future government consumption. Well, if this kind of intertemporal government budget constraint is admissible, then we find that it should be optimal to tax as much capital revenues as possible in the first period, and then set the capital income tax rates to 0 afterwards. So why is this a case? Well, in the very first period when this new capital income tax is imposed, this does not provide any distortion, because the present capital stock is a result of my last period investments, or the investments or savings over the last couple of periods. But of course, this kind of policy is time inconsistent. So if it's optimal for the government to tax capital income taxes prohibitively in the present period but not in the future, how could I, as a saver, not be certain that the government does not repeat this kind of policy next period, or in 2 years, or in 3 years? Well, and therefore this policy is considered time inconsistent, and the government should refrain from it. Okay, this terminates our lecture on the theory, and I will now proceed to the computation of these results in either with Gauss or with MATLAB. So therefore, I advise you to upload the program either in MATLAB or Gauss and start the next video, which will tell you how to compute these solutions.